We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Julian Brigden, co-founder of Macro Intelligence 2 Partners. Julian, thanks for joining me today.
Thank you very much for having me.
Great to have you back, and I'm looking forward to this conversation today, especially considering something that we talked about before we hit record here this morning, and that's the idea that you brought forward of macro purgatory. So what is the macro purgatory that we're in? And let's get an understanding of why you see that the way it is, please.
So I think the starting point has to be what typically happens after an aggressive tightening cycle, Tom, right? So if you go back, and we've done this, and you go back and you look at history, the base case is not a soft landing, right? It's not this sort of Goldilocks scenario where inflation withers to, back to target, where growth maybe slows, but then kind of reaccelerates. That is not the base case. The base case is statistically a recession, about 65, 70%. There is a additional about 8 to 10% chance, looking at history, of a reacceleration, but an accompanying reacceleration in inflation. And this is what the markets are kind of, particularly the bond market, is looking for clues for. And this is why we're stuck. So what typically gives you the clue that you're moving into recession is a significant pickup in unemployment. Mm-hmm. Now, unemployment is an odd metric. It is, we've talked about this quite a lot, a momentum play. You can literally run a moving average over it, and you can figure out what level it typically crosses to trigger a recession. And, in that sense, it's very, very unlike most traditional macro economic metrics. And once it rises, it tends to keep going. And so the average rise in a post-war period is about 3.3%, which off the lows of 3.4 would get you 6.7%, right? Now, if you turn around to people today and you said, based upon history, going back to 1960, unemployment's rising to 6.7%, they'd be horrified, right? Mm-hmm. Certainly isn't present in the markets. So we're looking for clues as to whether that's happening, and we look at all the labor data and try and pull that picture together. And then obviously in that scenario, you'd see a big rally in fixed income. You'd probably see a lot of weakness in the equity market, because I know that this is concept that these days we'll just pile into tech stocks, and they'll be our kind of ersatz bonds, replacement bonds. And people have used the COVID period for that example, but I think they're missing the point that during the COVID period, the Fed blew out the balance sheet, right? And it's not clear to me at all that that's necessarily going to happen, particularly if the trigger for that downturn in stocks is perhaps, at least initially, higher inflation. And then on the other side of the equation, if you're looking for the inflation picture, then you're looking for anything to do with prices. Are prices continuing to fall, or have we seen an anomalous period where it looks like prices are falling, but in actual fact, they're really not falling quite as much as you would like? And I think this is something that the Fed has tried, but done an absolutely crappy job, to be honest, Tom, alluding to. Powell talked about, at least in the post-FOMC commentary, he talked about this. And then, he comes out, the other day, and he's like, oh, it's all moving in the right direction. It's all good. And I think, this really plays to the market's sort of bullishness. So I think until we get a resolution of is employment materially weakening, in which case buy bonds, sell stocks, or is inflation coming back? Growth is actually relatively robust, and this improvement in inflation is somewhat illusory. Mm-hmm. In which case, sell bonds, probably sell stocks, right? That's why we're in this kind of macro purgatory. We're looking for clues, and we just keep chopping in what seem to be ever tighter ranges.
Julian, you mentioned that basically the Fed hasn't achieved its stated goal. What role does the Treasury and Janet Yellen have to play kind of undermining the ability of the Fed to achieve its goal?
Oh, I think a huge one, Tom, right? I think, look, I'm a big believer in liquidity driving asset prices, right? I mean, I have been since, QE3 actually. So we're going many, many years ago now. We had not QE infinity, or QE infinity, not QE, and then COVID QE. But I remember drawing a line on the stated announcements where they came out and said what they were going to do for QE3, and looking at the correlation between the equity market and QE1 and QE2, and putting a projection on where the S&P was going some 9 months later, and I was off by 25 points. So I'm a big believer that liquidity drives stuff. So, but there's different types of liquidity. Obviously, the Fed has a liquidity valve via the balance sheet, but Janet Yellen had access to liquidity via essentially the TGA, so the government's checking account, which she could draw down, so she could finance government spending, without having to draw upon market liquidity. And then the second one that she had was this reverse repo pool that was sitting there to sort of support the bond market. And that was very, very large. And by slewing how she issued government debt more towards the bill market, she could kind of draw that down. But as the Fed was trying to tighten liquidity, Janet Yellen was trying to offset essentially what the Fed was trying to do. And I think, absent her playing interference, let's say, at the very minimum, we can call it interference, as opposed to directly trying to offset what they were doing, I think we would have probably seen more asset weakness if QE had been allowed to fully play out. And I think that probably would have tipped us into a recession, arguably maybe at the beginning of this year, end of last year. But she did. So she's offset that. But look, it's understandable, Tom. I mean, she has a very different remit, right? Her remit runs till November. And, what happens thereafter, fine, right? As long as you get re-elected, right? That's her only remit.
Right. And the only other thing I wanted to touch on here is this idea of these Goldilocks times, where the economy is not too hot nor too cold to cause a recession. How many times in history have we had a condition like this? And how rare is that actual situation?
So we've had 12 tightening cycles since 1960. We've had 8 hard landings. So base case, 75% hard landing. Now, I will say in most of those, I'm pretty certain that the FOMC went into that hoping that they could achieve a soft landing. And, if you follow some of my peers on Twitter, some people have done, I think the guy from Cantor, is quite keen on pointing out how many headlines around prior tightening cycles they talk about, a soft landing, and then it goes wrong, right? So base case, 1 in 4 soft landing. But then you have to go back and you have to look at those prior soft landings. So the first one we got was 1966, 1967. 1 in 3. So soft landing. So then you go back and you look at, say, the first one, 1966, 1967. So 1966, 1967, we started off interesting with the same level of unemployment. So extraordinarily low level of unemployment, Tom. The inflation breaks out, the Fed hikes, they then get a wobble in the equity market, a little mini credit crunch, and they ease. And they ease too early in an environment of ongoing fiscal spending. So you can see the current analogies, right, to the present situation. And the economy never loses momentum. Unemployment never rises. Kind of kinks and then dips again. And you could call that a soft landing. The problem is that within 12 months, inflation had reasserted itself as wages took off, because we were starting with such low levels of unemployment that we frankly didn't have the workers and the slack in the labor market to enable the economy to reaccelerate. without driving up wages. Okay, so I think you have to call that a failed attempt at a soft landing. Right, took a little bit more longer than the direct hard landing, but it was a failed attempt. Okay, so then you have 9 out of 12. Right, so then your odds are down to even murder. Then you look at the other scenarios. Now, the one that the equity market likes to focus on and truly would deliver a soft landing is the late 1990s. It is also the last time that the Fed followed a similar monetary policy. It's called opportunistic disinflation, which is something that Greenspan tried to pursue in the late 1990s. Now, the starting point was easier. Unemployment was a lot higher. So more of that slack to kind of grow into. Wages were not as high as they currently are. But the big thing that really delivered the Goldilocks scenario, the get out of jail free card, was a burst of productivity. And so from basically the late 1994 into 2000, productivity explodes as we're in the foothills of the dot-com cycle, right? As the internet is starting to make itself felt. And that productivity gain delivered nirvana. It enabled you to run super high nominal GDP, 6%, which is roughly 5.5 to 6% is roughly where we're running at the moment. And that's your baseline for corporate earnings, right? Just think of it like that, right? That's pretty damn good, okay? Secondly, it enabled you to lower inflation, great for the bond market. So you've got, that's also great for the equity market because your PEs can move and your discount factor is lowered. And then thirdly, it's great for the real economy because wages can rise without being inflationary and employment can improve. So that was the true Goldilocks, but that's only 1 in 12. And then when you look at the other two scenarios, the two remaining scenarios, once again, we started, Tom, with significantly higher levels of unemployment, materially higher levels of unemployment. So as growth re-accelerated, there was plenty of slack to keep employing people and have non-inflationary growth again. The current setup, I think it lends itself to something where there are analogies to that late 60s period, where it kind of looks like you've achieved it. But if growth were to re-accelerate from here, my fear is what we would find is wages would re-accelerate again. And I think already the level of wages is really uncomfortably high for the Fed to be able to deliver what the market is pricing in.
Mm-hmm. So, Julian, you called the inflation trajectory over the last couple of years, and especially the top, quite well. So why don't you explain to us what factors you were looking at to have that understanding and, how you were able to understand that trajectory?
So I think if you look at it from a big picture perspective, we started to write about the breakdown of globalization in 2018. We wrote a series of things where we sort of said, we drew the analogy between the divorce and China and the US relationship. And we sort of said, when love breaks down and then we got to the divorce and then we got to the lawyer stage and whatever. So deglobalization. The second thing that we looked at was the resurgence of a Cold War and potentially a hot war. And we started to talk about that in 2020, late 2019, before Ukraine. Didn't foresee Ukraine. And we looked at some Bank of England work that they'd done going back 700 years, where they talked about periods of, they called it low real rates. They looked at what created those, and what created those periods of low inflation and low real rates, which is exactly what we've kind of enjoyed since the GFC in particular, is that you had an expansion of globalization and a dividend, a peace dividend, for want of a better term. So since the collapse of the Berlin Wall, we've been in this sort of globalization period. It's allowed because you had the period of peace, and those factors were already reversing, Tom. So those two together kind of created the big picture. And then there's the demographic picture, which doesn't lend itself to lower inflation, actually lends itself to higher inflation. Now, so those were kind of things. And then when we started to look at, when we got into COVID, what really drove our call on inflation then was really the not only the vast increase in monetary expansion, right, which is not always truly inflationary in the sense of CPI inflation. It's asset inflationary, but it isn't a CPI inflationary. But what is CPI is when you put fiscal with that. So we had a series of models where we looked at the size of the expansion of the combined monetary and fiscal stimulus relative to the output gap in the US economy. And what that gave us was, basically 10% CPI. So, when we started to call for this in early 2021, people thought we were clinically insane, right? I remember one of my hedge fund clients calling me up after I'd presented to them and saying, you're an idiot. There's no way. Well, better to be lucky than smart. So those were some of the factors that we were thinking. And so where does it put us now? So if you look at stuff, Tom, what's kind of intriguing is if you go back to history and you even go back to look at the 1940s, and I'm not saying this is necessarily the 60s into the 70s, I can connect those dots, but I'm not saying we're there. But even in the 1940s, you ended up with an echo of the inflation burst. You end up with an immediate post-war one, and then you end up another one, echo in inflation in the late 1940s. And so when I look at the improvement in inflation that we've seen, a lot of it is a function of really aggressive drop in goods prices. Okay, so we're back to goods price zero inflation or disinflation. In fact, at the moment, we're running disinflation. So if you look at core goods, so you take energy out, and core CPI is a function of core goods about a third of the weighting and core services about 2/3. But traditionally, you're much, much more heavily correlated to core services, right? Because we're a service-based economy, right? So you look at that. Core goods is now running at the second lowest level in 65 years. Okay? Now, when we look at core goods, and core services is still quite sticky, right? The concept to me that the Fed is contemplating cutting rates, right, and even talking about it, when core service inflation, which is a function of wages, is sitting above 5% and has sat there since the end of last year, is ridiculous. And in fact, I think the two most sensible central banks at the moment are the RBNZ and the RBA. And both of those central banks have come out and said, if this, people don't stop controlling inflation and we don't get these service prices down, we will be hiking again, right? We will have to drive weakness in the labor market to break the back of inflation, right? We have a Fed that is, for whatever reason,
Julian, that's Australia and New Zealand, right?
Sorry. Yes, the Reserve Bank of Australia and the Reserve Bank of New Zealand.
Sorry.
Even ECB's hinted at this issue with wages and core service inflation. Mm-hmm. And so we have this set up where, sure, inflation's been falling. Service inflation has been coming down, but not as rapidly as goods. And so now we have this situation where we have the second lowest goods inflation in 65 years. And the question you have to ask yourself is, do core services continue to, do they start to pick up the slack as maybe goods inflation becomes less disinflationary? Because base effects are going to be quite powerful as we move into the end of the first quarter of next year. And even by the end of the third quarter of this year, very, very powerful, and could drive goods inflation to a less negative level. Like Tom, I'm not talking about back to positive, but a less negative level, right? Now, if that were to happen and service inflation does not accelerate down, and as I said, to me, because of the correlation between core services and core wages, if you were to see that core service inflation start to really drop, that would actually be a sign of wages weakening, and that's a recessionary signal. And I don't see that right here, right now. So I'm in the camp that the risk is actually, as we start moving really from next month, but especially in September and October, which would be perfect timing for problems to create problems in the equity market, because that's the season agreed period for the equity market, that actually a lot of this narrative of ding dong, the inflation witch is dead, actually could start to reverse. And I think there's a lot of risk in a market where this Goldilocks scenario is priced to beyond perfection, right? To beyond perfection. If you look at some of the survey data from people like B of A, you can see that, I mean, a massive majority of respondents expect, and you're up in 90%, are expecting between 2 and 4 rate cuts over the next 12 months. What if we get to September and inflation hasn't fallen? It's a base case. Inflation hasn't fallen at all. It's still sticky. Headlines at 3.3, 3.4. Core hasn't fallen. Fed can't cut. What happens to the market that's truly built that into its assumptions? I think, for a bond market which is pricing in over 100 basis points of cuts between September of this year and September of next year, that things like that start to create significant problems. And likewise, I think for an equity market.
Mm-hmm. How does this situation, how is it almost more complicated trying to curb the labor market in this hyper-financialized economy? Does that add a degree of difficulty for the Fed?
Oh, massively. I mean, hyper-financialization is something that we, in this context, we coined back in 2016. And the way that we use it, Tom, is we use it in the sense that logic would dictate that the real economy should drive asset prices. Okay, the GDP growth should determine baseline corporate profitability. Wages should help determine margins. Inflation should help determine bond yields, et cetera, right? But in the US, we have this bizarre setup, even more so, some elements in the rest of the world, but really hyper important in the US, where financial assets, and particularly equities, via their feedback loop into CEO behavior, drive things like employment particularly, but also capex. So, and I think this is just this bizarre remuneration structure we have, where we pay CEOs not to make a profit. I mean, up until recently, Tom, we penalized them for making a profit, right? Because they were, that was essentially restricting growth, mm-hmm. right? And what that really meant is growth in their stock price, right? So where we remunerate CEOs based upon their equity performance, and so their benchmark is logically, right? These are personal maximizers, right? They maximize for share. They call it shareholder value, but it's really, I'll be much more cynical. I'll call it stock option holder value, which is what they own, right? We remunerate them accordingly. And so when stocks are rising, you can see very strong correlations to overall employment growth. And when stocks tend to fall, they reach for the cost-cutting axe, and that means they cut, travel budgets and expenses and capex, and tend to cut employment quite aggressively. So what you find is that employment lags the overall equity market. And so the problem this creates for a Fed is it's actually quite hard. If we have a situation, if we follow this line of thought, if the equity market leads employment, and employment leads wages, and overall wages lead core service inflation, and core service inflation leads core inflation, that if you want to address core inflation without taking the equity market down, it's incredibly hard. Mm-hmm. And then, of course, the minute you take the equity market down, particularly from such lofty levels that we are now, your ability to stop it you can't, it's hard just to take it down a bit. Right? I mean, I think that's what the Fed was trying to achieve with QT, and it's just Janet stopped them. And now we have arguably, certainly in certain sectors without question, bubbles. So we all know that generally when you deflate a bubble, it pops. It doesn't, the gas doesn't just slowly leak out of the system. So I think, yes, to your answer to your question, Tom, is extraordinarily hard. That's why I think this assumption of no recession, given that historically it's the base case, and also with the current setup in markets, I think is ludicrous. It's just, how do we get there? Do we get a bit more inflation and that bursts the bubble? Do we get the weakness in employment and that bursts the bubble? That's why we're sitting here as a bond market trying to figure this out and win this sort of macro purgatory.
Well, Julian, considering, what a complicated equation this actually ends up being, do you think that there's any of the metrics that the Fed has at its disposal or makes decisions based upon that are too lagging or imperfect measurements? Metrics like employment data, GDP, CPI. I spoke with Danielle DiMartino Booth a couple of weeks ago about revisions to the employment data that come out. And she said that it's starting to roll over, but it's, in some ways such a reverse looking metric that it makes it very difficult to be able to actually base, let's say, timely execution of monetary policy on.
Yeah. Look, I mean, the Fed is to a degree a victim of their own self, right? I mean, they are a super tanker. It takes a long time for, there are monetary lags. So when they cut rates, it takes a long time to sort of, fit into the system. They're not supposed to be doing what the bond market does. They're not supposed to be cutting, hiking, optimistic, negative, right? It's supposed to be steady linear path. And so definitionally that makes them slower moving, Tom, and the metrics that they look at are, as a result, sort of slower moving. I mean, I think they've tried to do a better job at trying to speed up some of the metrics that they use. I'm sure, given how many PhDs work at the Fed, they'll come up with some better tools, but their hands are almost tied by these lagging indicators, as you correctly suggest. I mean, the data reviews are not great, but the length of history available around, more rapid data series. So whether you look at, the Indeed metric for employment, or whether you look at the Challenger metrics for employment, right? Those only things go back 20 years. That's really much to kind of get your teeth into if you're a big PhD economist, right? So I think their hands are tied. The second thing I think in the employment metrics, what's made it very complicated is this element of integration, right? So trying to cut out the noise from that is very, very hard. So this, traditionally, I can tell you, there is only one time in the last, I think it's 75 years, where we've had this level of unemployment relative to a moving average, which we watch, where we've not had a recession once. And that was that 66, 67, where it kind of briefly blipped up, came back down again, and inflation burst through. So if you look at this face value, Tom, we're heading for a recession. The problem is that weakness in the non-farm payroll number, and particularly the unemployment rate, is not backed up by other metrics. We're not anywhere close to the levels of Challenger layoff announcements. We're not even close to the levels of initial claims. Non-farm payroll should be negative at this point if we were that close to recession. So we're just not getting the confirmation, which does leave that unemployment rate a little tainted by the fact that what really could be happening is just the pool of workers is growing as we get immigrants. And so that unemployment rate is rising as a function of more people in the labor market. So, I think that makes their job even more complicated, right? So I think this is extraordinarily hard, but I have to say, and I would add in the politicization of the Fed, and that, I don't mean that this is a Fed that is woefully anti-Trump, and woefully pro-Biden. I think they're certainly more democratic than they are Trump, but I do believe, and I've been told this by policy friends, that there's a visceral fear, not just in the Fed, but in central banking circles of Trump. I mean, we saw, a few months ago, some very direct comments from Christine Lagarde directed at Donald Trump, right? And the fear that the ECB has. And that's really persona non grata as a foreign official to make those sorts of observations. But I think it's testimony to the level of fear in central bank circles about the policies that he implements. And I do think it's bizarre where if you look at his agenda and then you look at the statistical odds of him winning, which have clearly gone up post that absolutely atrocious Q&A that we had, the
debate.
The debate, yeah. Mm-hmm. When you look at that, Tom, and then you look at what's priced into the bond market, right? Let's push ourselves, to December of this year, right? Maybe we've got one rate cut, 25 basis points, right? Now that would be priced into the markets, but then current pricing, the market would be looking for another 75 basis points by September and 100 basis points by December of 2025. But let's put a situation where Trump comes in and he enacts his policies. Now, we don't know yet whether he will. He hasn't picked a Treasury secretary. We can only hope that he picks someone sensible who will dissuade him from some of these policies. But he shuts that border down. You immediately have wage pressure. Okay? Secondly, he imposes tariffs. Then I've seen projections that talk about core PCE, and they talk about it in this context, but roughly the same on core CPI, of being 150 basis points higher over the next year. In that scenario, you're not getting cuts, mate, you're getting hikes if the Fed's sticking to the letter of the law, right? And the Fed is in full-blown pissing match with the presidency, right? I mean, that could get an extraordinarily difficult situation, right? Extraordinarily difficult situation. So I look at this thing and I just think, I think we're coming to a really rich macro period. My asset of choice is precious metals. Because as I connect the dots, I don't see an easy way for us to solve these issues. But we just, right here, right now, we kind of need to figure out the direction of travel. And it's, as I said, we're stuck between, is it going to be weaker employment or is it going to be a resurgence in inflation? And that's keeping us in that. Those are my base cases. This Goldilocks, as I said, I think is going to get challenged. I think, longer term, I think there's coming we've already started to see a very rich macro environment, right? We're getting swings in assets that we haven't seen for a while. But right here, right now, we're in this sort of Purgatory period where we're trying to figure out, do we keep bumbling through, or does this sort of narrative of the Goldilocks scenario continue for a few more months? I think, as I said to you, I think September and October get interesting because if we haven't seen the weakness in the labour market by then I think the inflation picture will start to be challenging enough that we could see another leg higher in bond yields. Alternatively, if we do see the weakness in the labour market, not my base case, because I think we're seeing softness in labour, a softening in the labour market, but not weakness, right? Mm-hmm. Then, but if we were to see that, then, you'd be talking about an open recession. So to me, I think we just need to figure which way we go and then play that accordingly. But 2025, boy, oh boy, I mean, it could be, and 2026, it could be a really volatile period.
I think you did a great job of really explaining and laying out this idea that the markets of all types, really, maybe other than commodities at this point, are really priced to perfection. They're not pricing in the uncertainty of the election. They're not pricing in the ramifications of, as you said, extra imposition of tariffs, all kinds of things that are unseen possibilities at this point. And, when we look at the stock market, as you said, being driven by liquidity just seems to be really the only explanation for a lot of this loftiness that we're seeing.
Yeah, I think, look, when I look at the equity market, it's been right to be bullish. I mean, our longer term metrics suggest, you still stay bullish. But the issue is these particularly overvalued sectors, which look very bubblicious to me, right? I mean, Nvidia, I've sort of tweeted it out, and I looked at every single bubble going back in history, and you don't know yet, but if it looks similar to me, we may have put the absolute high in, right? And at which point you're going to get a sharp sell-off, another rally, failed, won't reach new highs. That'll be your bull trap. That's the classic sign of the top of a bubble. You go back and look at every single one. You initially get a big sell-off from the peak, then a bounce and failure. But I think we have to wait to see. But I look at this equity market, and to me, Tom, there's a very reflexive cycle that's gone on in the US, and it's not really exceptionalism. I mean, to me, I disagree with this term exceptionalism. Sure, there are some very exceptional US companies, but a lot of what we have going in the US is we are running a bloody great big fiscal deficit, right? We're spending 6% of GDP in terms of debt, and that isn't exceptional, right? That's not the definition. That's just, drunken debauchery when it comes to any ability to control your spending, right? Now, but that does have a consequence, and because what it does is it creates a very strong US economy, a US economy that runs, when it tends to be strong, tends to run either twin deficits, a budget deficit, which is large, which obviously we have, and also a current account deficit, because we're sucking in a lot of imports as a strong economy. And what has to be done is fund it. So how do you fund the budget deficit, and how do you fund the current account deficit? And we're not funding, as America, we can't fund the current account deficit, but we're not funding the budget deficit. Okay. So who is funding it? Well, Johnny Foreigner is funding it. And how are they funding it? Are they lending us money? Right? Or are they buying US assets? Well, they're lending us money to a degree. They're buying treasuries, but fewer than they did. They're certainly not lending the US banking system any money. So JP Morgan isn't borrowing trillions of dollars from Crédit Agricole or Deutsche Bank to lend to US consumers and companies to buy German machine tools or Japanese car imports, right? So what foreigners are doing is they're buying US assets. So what we create, Tom, is this self-reinforcing cycle between a strong US economy and strong US asset prices. Is that US exceptionalism if it's based on deficits? I don't think so. And I think it is very powerful as a cycle because it does self-reinforce in a true reflexive Soros-esque sense. So in other words, the purchase of the asset reinforces the fundamentals that underpin that asset. So you buy stocks, the fundamentals that underpin the stocks get better because the wealth effect creates more spending in the US, and so on and so forth, right? It's very powerful, but it is inherently unstable. And so when I look at 2025, I could see a lot of things going wrong, right? You end up with tariffs. You end up with a Fed that then has to get really aggressive and drives the economy into recession. Mm-hmm. Then what happens? The current account deficit shrinks. The money tends to go home, and US assets will underperform. Okay. The dollar could weaken because people could lose faith in, if we don't address the budget deficit, the dollar could weaken. All those inflows into US assets to fund our spending have been in unhedged euros, yen, so the money goes home. And, as the dollar weakens, the euro goes up, and then Mr. and Mrs. Schmidt look at their returns in Nvidia in euro terms, and they're falling, so they take their money home. That bursts the bubble. And thirdly, we could just burst this bubble in the US equity market, and then the money could go home. So I look at the current setup, and it's very powerful, but inherently unstable, Tom. It's this kind of three-legged stool dependent on ongoing economic strength, ongoing dollar strength, and ongoing equity strength. And anything that messes with that equation could upset and create this really aggressive cycle, which I think in that situation, ultimately, and I'll put it like that, ultimately that's when I want to be long precious metals. Mm-hmm. I say ultimately because at least initially, I think precious metals will relatively outperform US equities, but they may not rise. They can fall because they get caught up in the dislocation of the markets because money managers own them. They get what they call a VAR shock. So you get a shock across your portfolio and you have to deleverage as volatility rises. And then you end up selling even the assets that you like, so your gold and silver. So they won't drop as much as, say, Nvidia, right? But they will probably drop. So I think, relatively, yes, but then ultimately you come out the other side, the Fed cutting rates, they're liquefying the system again, and that's when gold and silver just, I think, truly explode.
Just to, let's say, dig into that a little bit more, Julian, in some ways, this order of operations, if we see the stock market, all of a sudden realize that it is only standing on 3 legs, does that also, in your mind, bring gold and silver down in that initial, let's say, liquidity crunch?
Yes.
Okay.
Probably. I mean, that's why, look, PA, I run it in two different ways. I mean, we've been long gold and silver for a while. I've been long gold and silver for a while. And it's a core part of my portfolio, but I'd like it to be bigger. But, you have to do one or two things. The first thing is you have to run stops on an outright basis. So to be very disciplined about that. And then the second thing, you have to be prepared to, if you can, sell something against it. So there are times, Tom, in the last few years where I've sat long silver and then I've sold the S&P against it. Mm-hmm. Right? Not everyone can do that. Not everyone wants to do that. But if not, you have to be disciplined about those stops, or you have to be willing to buy a dip. Mm-hmm. Because if I look at the technical setup, if we do end up, let's paint this a scenario. I'm not saying this is how it's going to pan out, but let's say, silver rallies into, September, October. We then get this inflation pickup. The economy's still doing all right, but the bond market wobbles. We get a sell-off in equities, and it's the beginning of something quite large, right? Then you could get up a situation where silver goes, all the way back to like $22, $24, right? Now, maybe you might be willing to sit with that as an individual. Certainly if it's in a taxable account, maybe you don't want to trade it. But you need to understand that that's the risk. In a big sell-off in stocks, and that typically, if you go back and look all the way at the 1930s, the transformationary period, the beginning of the big commodity precious metal bull runs, the basis, the kernel which creates those is typically a very, very sharp equity sell-off. And I'm talking 40, 50% type drawdowns. So,
Julian, you mentioned that you wanted your precious metals, let's say, portion of your portfolio to be bigger.
Yep.
How difficult of an equation, or how do you look at trying to find entry points when gold is within $100, $200 of its all-time high? Silver, obviously, a bit of a different
beast,
a little bit of a different situation at this point. But as a portfolio manager, that must be a difficult equation to solve for from an absolute level at this point versus a potential level that you see them going to.
On an absolute basis, look, it's challenging, right? We got the break. If you take silver, for example, we got the breakup of 28. And that was kind of the level that everyone was looking at. And then it just sort of got up to 30 and sort of ground to a halt, right? And now we're back. We tested those 28 levels, we held, whatever. What you need to see, what you need to be prepared for is, and this is an annoying thing to happen, Tom, in a way, is you need to be prepared to buy strength, right? So you need to be prepared to buy positive price action. We all would love, like, I'm a buyer if the thing drops down to 24, right? Well, what if it never gets from 28 to 24? What if it just sits at 28? It's overbought at 28, but 6 months later, you've worked off those overbought state, right? And then the next price is 29 or 30. Well, you need to look for breakout levels, and you need to be prepared to buy those breakout levels. And so that's one of the ways that you have to manage it. You either get lucky, you get the dip that you want, not too much of a dip that stops you out of your existing position, but just enough, just enough, Tom, that you'll be able to go, I know this thing is still in an uptrend. This is a correction within the trend. Thank you very much. I'm buying. But if you don't get those, you need to be willing to pay up, essentially, as you break your key levels on the top side. And it comes down to technicals, unless there's some, event that you said.
Are you buying physical gold and silver, or are you buying more, let's say, ETF type products or price following products?
I tend to buy financialized precious metals. I'm a little cynical on this one, Tom. I think if we get to the point that you need physical, okay, that the world is in such a bad place that really at that point, the only two metals that are worth owning are lead and brass in the form of a bullet. Because frankly, if I have to go and buy a loaf of bread with a piece of gold, firstly, it better be a bloody big loaf of bread, right? For a pretty small piece of gold.
That's why you have silver.
Yeah. I mean, lots of little bits of silver. But I think the world is a very scary, scary place at that point. And I'm not sure that, I hope we never get there. I don't think we get there, right? So I think this is probably the big bull run is probably is more a function of monetary debasement as opposed to societal collapse. I hope.
And again, that is partially your position as an asset manager, right? Which gives you that comfort dealing with those products.
Yeah. I mean, look, I can see why people might want to have some silver and some physical, and I have some stuff in investment trusts which is physically backed, right? But I also am quite willing at some point to buy the miners. I mean, the miners have been a pretty poor performer so far. But I'm still optimistic that those guys will come back. And once they start to come back, but you'll probably need to see dollar weakness and the Fed cutting, which I think is only a function of pain, Tom, right? That's when the recession is hitting, right? That's when the Fed, I don't think we slide straight into, you don't go straight to collect your $200, like you go to jail first, right? So in that scenario, I think, paper gold assets probably, and those are miners basically, will underperform. And then you have to wait for the Fed to go, oh dear, we're in a recession, unemployment really is spiking. Stocks are under a lot of pressure. Okay, we cut rates. We maybe expand the balance sheet and the dollar starts to weaken. And that's when I really think precious metals will take off and the miners will outperform, but we're not there yet.
So, really, I guess what you're trying to say is to blame for the weakness in the miners at this point, or let's not say blame, but we really need a rotation of capital and a recognition of that, sector of businesses that is really doing well at that time, that is currently being overshadowed by this extremally strong growth stock market that, as you said, is just so precariously perched at this point.
Right. So as I said, this flexive cycle between a strong economy and strong asset prices is driving money into these dominant sectors, right? And you need that cycle to break, right? To start money moving out of those sectors. You could say it'll be the same thing that'll move money out of the US and into emerging markets. It'll be the same thing that'll move money out of, growth stocks into value stocks. It's the same setup, but you need the current cycle to end, right? And if you look at 2000, the post-dot-com bubble period, and please don't get me wrong, I'm not saying that, Nvidia's like pets.com was in 2000. Right? It's a credible company. It has real revenue growth, but this is not really, in these periods, this is not really about PEs or revenues. This is simply about ownership.
It almost seems like momentum at this point.
Yeah, it is exactly that, right? I mean, we've all seen the sort of analogy I like to use is, when you look at a jet fighter going vertical, right? We've all seen the videos, right? Or the movie thing, right? That goes straight up, right? Well, what happens is it looks like it's going to the moon, right? It sucks more and more and more air into those jets, and it goes straight up. The problem is at some point the air gets pretty thin, Tom, right? Unless you've got a scramjet at that point, what's going to happen is the plane stalls out, and it doesn't fly off sideways. It drops. What you hope to happen is the engines catch again, and then you come back up again, right? And that's what bubbles are created by. You run out of air to suck into the momentum, and it's not to do with PEs. It's not to do with revenues. If you look at Microsoft and Cisco in 2000, both totally credible companies, right? Yeah, sure, their PEs got very high, but they were growing into their PEs. So Cisco's PE and Microsoft's PEs peaked in 99. They were growing into their PEs in March of 2000 when the bubble burst, right? So Nvidia is growing into its PE. It doesn't mean the stock can't drop, because the stock, when you've got every single hedge fund long, every single ETF up to its max weighting, right? We saw the XLK, the tech ETF, reweight Nvidia last month, right? Quadruple its weighting, right? So they are max long. They can't buy any more Nvidia because of concentration risk controls, right? So once you get that situation, where is the marginal buyer coming from, right? And that's when risk set up. So, but let's see if that follows through, and you've got to find a trigger for that to happen. And if that happens, and then that those dynamics start to wobble around the three-legged stool, because we're starting to see, equity underperformance, and that trick signals CEOs to start laying off people, right? And then the Fed starts to cut, and then the dollar starts to weaken. Then that's when you're going to see, I think, these precious metal moves come through. But we're not there yet, Tom. We do not have the trigger yet, sir. So this momentum game kind of continues, as I said, very powerful, self-reinforcing, but inherently unstable, and I think very stretched and vulnerable, since it's predicated on this uber discounted Goldilocks assumptions.
Obviously, we're always trying to balance risk versus upside return in these situations, Julian. So what do you see as the most likely, let's say, trigger for that situation to make you more comfortable to make those entries? Is it, as we discussed, that really recognition by the Fed that all of these markets are getting weaker and an actual move to cut?
Yeah. So I think so if we're talking about precious metals specifically, there'd be a number of things. Firstly, you need to see a sell-off first. You need to see pain. And pain is very important. Then you can look at things like, there are typically historic levels that things like the VIX spike to before you kind of get that blow off degrossing of risk portfolios created by the volatility spike. And so fund managers are basically just selling positions as they're trying to reduce their risk. So there are metrics that you can watch kind of real time that give you sort of a clue of pain, Tom, right? Pain. Mm-hmm. So that's one thing. The second thing, you'd want to see a recognition by the Fed that we've got to that point. So you'd be looking for commentary, that they're getting to the point of pain where they're willing to either cut rates or, more importantly, start QE again potentially, right? So it's a combination of factors that you're watching, that you've learned over time. But I mean, the old adage is true. When the streets are full of blood, right, it's when you want to buy. And the problem that is that most people go into these events max long risk. Mm-hmm. Whether fund managers, because their models use some sort of form of trailing volatility, and volatility in an upward trend tends to trend down, so they tend to be max long risk. Whether it's things like correlation risk, which measures movements in relative assets, and at the moment we have historically low correlation risk within the S&P, so long short equity managers can be max long their holdings because their shorts are working versus their longs, right? It's all those sorts of things that tend to leave us well over our skis, right? Retail investors tend to be fully in, right? And they tend to get, Nvidia's going to 2,000, right? It tends to be enthusiasm because markets are driven ultimately, Tom, by greed. Mm-hmm. At the highs. It's greed. What do you mean you haven't got Nvidia, you idiot, right? You should, I've made blah, blah, blah. I remember a classic analogy I had. I went to a cocktail party in 2000, and I'm aging myself here, but it was Christmas of 2000 99 cocktail party in New York. And I was with a girlfriend, and she was desperate to meet some guy, as every female in New York at that age was. And this thing was a target-rich environment. It was a bunch of hedge fund guys that I knew, and we were meeting up at this party. And there was this guy there from More Capital. And Juliana, my friend, started talking to him, and I was overhearing the conversation. And she said, who do you work for? And, More Capital. And he goes, how much are you up this year? And he goes, well, I'm up about 15%. Right? Now, she didn't know that this guy was up 15% every year. He was a great fund manager, right? Her comment was, that's shit. Right? I'm long Cisco and EMC, and I'm up 60%. Right? And that is emblematic of that sort of greed in the retail side. And of course, 4 months later, her early retirement, aspirations had evaporated. Mm-hmm. Right? So it's just very funny that you get these extreme euphoria to the point that you're arrogant enough to tell a highly successful hedge fund manager that your performance is shit. Mm-hmm. Right?
Absolutely. So I was going to say, and also, I think at these peaks and this lack of recognition of that peak is also due to, this time is different for some ridiculous reason, whatever that might be.
This time is different. Look, I think AI will ultimately deliver the productivity which probably enables us to live in that kind of high growth, lower inflationary environment, right? It just takes time to implement, and it certainly isn't showing up in any of the official data yet. If you look at productivity growth, it's basically fallen for the last 3 to 4 years. It's not risen at all, mm-hmm. right? Not risen at all. And I think the implementation of AI could prove quite challenging. I think the classic example, we just saw McDonald's and IBM drop this project for what should be, in the scheme of tech, be relatively easy, and that's automating your drive-through experience, right? And they just couldn't get it right. Mm-hmm. So and they didn't just say, oh, it's going to take longer. They bloody abandoned the project, Tom. So I think, the real world implementation of this thing will be tremendously powerful. Do not get me wrong. But when? And if it isn't in the next 6 months, then that could be a big problem for markets and the Fed.
Mm-hmm. But I think that's it's also, such an unknown factor, because the real world implementation of AI that creates actual, whether that's energy, whether it's more steel, more raw products, more maybe an application in the mining sector that is able to find better deposits, whatever real world tangible asset application that might have. I think that is, obviously further out than you getting your McDonald's hamburger faster, which has already been kicked down the road.
Yeah, you would think so. That's why, look, I'm bullish on the story. I'm bearish on the assumption around the speed of the implementation, and I think that creates macro problems in terms of potential inflation, and the ability of us to deliver that Goldilocks where inflation falls and growth re-accelerates or stays where it is. Right.
Mm-hmm. Julian, I'd like to kind of close by getting your thoughts about how the Fed starting to cut and this recognition of non-Goldilocks zone, what that ultimately ends up doing to the bond market, and if that possibly precipitates some type of recognition by the rest of the world of the weakness of the dollar, the value of the dollar, the path of the Fed, and the effect of fiscal dominance on the value of that asset.
Yeah, lots of stuff going on there. So look, I think, as I said to you earlier, I think the Fed's trying to pursue a policy which they've only pursued in the late 1990s, okay, where there's a trade-off between how far you take, so what's referred to, Tom, as the terminal rate of interest rates, how far you push them relative to growth and inflation. And we actually kept them quite low relative to the level of growth and inflation of a typical tightening cycle. A typical tightening cycle would have seen rates go 100 basis points over nominal GDP, which at its high was about 6 and change. So the Fed funds should have gone to 7+%, right? So the Fed didn't do that. They kept them lower than they traditionally would, which is what they did in the late 90s, but there was a trade-off. And the trade-off was, sure, they tweaked a little bit, right? So they cut them 75 basis points off the highs in the mid-1990s, but then they went on hold in this sort of higher for longer for basically 2.5 years, right? So what I think the bond market has overlooked, because the Fed has done a poor job at kind of explaining it, and the Fed sort of hopes this isn't the case to some degree, but they do still talk about higher for longer. I think what they should have really said is this could be just a mid-cycle slowdown, guys, right? So we might tweak a little bit, 50, 75, but then the next move could be as up as it could be down. And that's what the RBNZ and the RBA have said, the RBNZ in particular. And so I think there's a possibility, let's say we get a September cut. I don't think that's the case, unless something goes wrong. I think the market's premature on that. I think November's probably more likely. But let's say we do get that. If everything is ticking over okay, then I think next year you won't even get close to what's being currently priced into equity, into bond markets, right? So you get nothing. Now, that could lead to a big repricing at the long end of the curve, because we're already discounting an awful lot of cut, and particularly in the belly, so 5 to 10 years, has to materially reprice, and yields move higher. And then you get to, quite problematic situations. The one that's really, though, more problematic, I think, for the bond market, which brings you closer to the fiscal dominance situation, is probably the Trump win and his unwillingness to raise taxes. I think the Democrats are probably closer, certainly, to raise taxes on corporations and the high end, but Trump's unwillingness to raise taxes and potentially his inflationary impact from from tariffs and his determination to roll over the existing tax cuts, right? So if you see a situation where that happens and you start to get pressure at the long end, the really bullish scenario for precious metal, not a nice one, guys, right? I've seen people, Tom, talk about, $125 to sort of $150 silver prices. And I'll be very clear to people that, sure, I think if you look at it, technically, it's possible, right? A very long-term, sort of chart pattern. It's very technical, possible. But you won't like that world, right? I'm not aspiring for a $125 place at all. But what would be very bullish, because what would be very bullish with precious metals is you get to a situation where the US economy moves into a recession. You get an initial rally in the bond market, so yields fall initially on the back of that recessionary impact. But then the Fed comes in and starts to stimulate, and then all of a sudden people go, well, wait a second. They're stimulating. We've got fiscal spending will have increased during recession relative because automatic stabilizers kick in. So your tax revenues drop and your spending increases, unemployment and that sort of thing. And then maybe Congress tries to spend even more money, particularly under, say, Trump. We've got to get this equity market back up. We've got to get stimulus going because I'll be coming up to midterms at that point, right, Tom? So I daren't lose, control of the House or the Senate. And then the bond market just go, whoa, right? I am out of here, right? If you're doing this, I am truly out of here. And yields start to spike. And then the Fed is forced into this situation where they have to suddenly make a decision. And as my good friend Mike Taylor talks about, the ultimate role of the Fed or any central bank is the solvency of their boss, and the point at which they have to decide between fighting inflation and the fiscal solvency of the government. And they come in and they try and cap yields, or they do QE to try and buy bonds. That's when precious metals are going to explode.
Well, Julian, I really appreciate your thorough explanation of all of these concepts here today.
And I'm sorry it's a bit complicated at the moment, Tom.
Well, it absolutely is, but that's why we need to have these, long, nuanced conversations to fully be able to try to, price in a lot of these different concepts, right? And understand them.
Yeah. And as I said, I think, from my perspective, we're running, quite tight risk, not a ton of risk until we see which way this thing breaks, in terms of, is it going to be economy still ticking over, but inflation comes back, or the economy rolls over via employment. My bias is at the moment for the former, because while I'm seeing softness in the labor market, it's not a soft labor market. I'm biased for higher bond yields and what that can do to pressure, what it can do to stocks. So I think we're at a very interesting point, and we'll push once we see those movements. But it's nuanced. It's this balancing game, right? And that's why we're in this, what I will refer to at the moment, this kind of macro purgatory. And it's doing my head in, and very, very frustrating. But we get those sometimes. You have to know when to press the gas and when to step away. Absolutely.
For anybody that would like to read more or see more of Julian's work, on Twitter at Julian MI2, mi2partners.com, and of course, mi2partners.substack.com.
Yeah. So, or alternatively, you want to reach out on any of the institutional product or the stuff that I do with Raoul on Real Vision, Macro Insiders, just contact support at mi2partners.com.
Excellent.
Perfect.
Julian, thanks so much for your time today.
Pleasure, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.